Whatever inventory method you're going to be using, it does have to be disclosed. Disclosure means the financial statements should report enough information for outsiders to make informed decisions. Therefore, you need to disclose what inventory systems you are using. If you also, the GAAP principle of representation faithfulness means the properly disclosing inventory methods and substance of all material transactions. So if you had a significant write-down of some old inventory, that also needs to be disclosed. And then consistency. And when we talk about consistency, this is what I mentioned to you earlier. I know it sounds like a lot of times we're talking about how companies just can do whatever they want and make things turn so that they make their numbers look good or bad or whatever they want. But in the end, when we're talking about generally accepted accounting principles and when you're preparing financial statements, you must be consistent in how you prepare it. In other words, you have to be consistent from your periods to other periods. You can't be switching back and forth. Oh, this year I'm going to use LIFO, and then no, let's use FIFO this year just to make our inventories look better or worse depending on the circumstances. No. Once you pick one, you have to be consistent with that. And if you're going to make a change, there better be a very good reason to make that change. And when I say very good reason, you better be ready to argue that making that change provides better information to the financial statement user. So consistency with itself, the company must use the same from period to period, but also consistency how you report your inventory and your cost of goods sold relative to others in the same industry. If not, and something goes wrong, it could be difficult for you to argue that you didn't do that intentionally, especially if you made your numbers look better than what they should have, and people invested in your company and they lost their money. You could bet you better be ready to defend that, and that's going to be tough, and especially when you're sued. After all this that we've talked about inventory systems, we've talked about inventory methods. Now let's talk about the rule associated with inventory. And that rule is called the lower of cost or market, or LCM rule. And so what this means is that I don't care if you're using LIFO, FIFO, average cost, specific identification. That's a decision that's already been made. Now we have to say, so without regard to what inventory system, a company is still required to report the lower of the historical cost, which is what we just went through, the process we went through. But if it turns out that the market value is actually lower than the cost, then we then must make a markdown or a write down of that value. So our inventory must be the lower of historical costs or the market value. Now, when we say the market value, generally we mean the net realizable value. Let's take a look. So in this example here, Under Armour Incorporated paid $3 million for inventory. That was the cost. By its year end, the inventory can be replaced for $2 million. In other words, if it had to replace that inventory to go buy it again, it would only pay $2 million for it. Under Armour's year-end balance sheet must report this inventory at the lower of cost or market value of $2 million. So even though Under Armour paid $3 million, their inventory must be adjusted to $2 million. So in this example here, Under Armour paid $3 million. So there's $3 million in inventory, and let's assume they bought it on account. And for whatever reason, they didn't sell any of it, so it's still sitting in inventory. And when they go back and do a quick analysis, they figured out that they can buy that same inventory for just $2 million. Maybe it's becoming obsolete or whatever it is. They haven't even sold it yet. But it doesn't matter. Even though they haven't sold it, they're going to have to lower that value down to $2 million. Now, to make that happen, they're going to have to credit inventory for $1 million. Once they do that, their ending balance, the amount that's going to be left on that inventory, is the $2 million. That is the net realizable value. Now, if you credit inventory, what's your debit? Well, the debit's going to be just like if it were anything else. The debit's going to be the cost of goods sold. And what you've done is you've written off $1 million of inventory towards the cost of goods sold, which is going to have a negative impact to your income. So your income is going to drop by that $1 million. You purchased it for $3 million, it's now only worth $2 million. Now you're going to have to write it off. So there's the debit to the cost of goods sold for $1 million, and there's the credit to inventory, and it's the wrote inventory down to market value. So on the balance sheet, you're going to report $2 million. You're going to disclose that you purchased it for $3 million, but if there's only $2 million there, so that's what the net realizable value. And the cost of goods sold is going to be, originally it was $9 million, but you're going to add another $1 million that you wrote down. So you're lowering your income by that $1 million.